All right, let's jump right into this explainer and unpack the wild financial tug-of-war happening right now over at Eos Energy. Now, if you follow the energy grid transition, you know the drill. Long-duration storage, it's not just a nice-to-have anymore. It is a structural necessity, driven largely by the massive boom in data centers and industrial expansion. Eos is sitting right at the absolute center of this demand. But as their latest filings show, having the right tech at the exact right time doesn't automatically, magically create a perfect balance sheet.
So the big question we really need to answer today is Eos Energy a breakout success, finally hitting its operational stride, or are they stepping into a massive debt trap? We're looking at a company at a major crossroads here. And as we dig into their Q1 2026 earnings, the 2025 annual report, and the recent SEC filings, you're going to see two completely different realities playing out at the exact same time. To break this down as neutrally as possible, we're going to structure this explainer as a direct point-counterpoint debate. It's the bull versus the bear. We'll be contrasting the explosive external market demand for Eos's batteries with the very real, very heavy internal financial pressures the company is actively trying to manage.
Okay, let's kick things off with the bull case: explosive revenue growth. Check out the sheer commercial momentum they generated in the first quarter alone. Eos just posted $57 million in Q1 revenue. Just to put that into perspective for a second, the last 2 quarters combined actually surpassed their entire full-year 2025 revenue, which was $114 million. Their production lines are clearly turning input dollars into output at a rapidly accelerating rate. That translates to an incredible 445% surge year over year, literally jumping from about $10.5 million to nearly $57 million. And that was driven by an increase in physical battery deliveries, a higher average selling price, and some extra revenue from third-party materials. The business is demonstrably scaling up.
The bulls will also point enthusiastically to this number, a $701 million contracted backlog. When you pair that with a commercial pipeline they estimate at over $24 billion, it proves the structural demand for their long-duration zinc-based storage is absolutely real. Utilities and hyperscalers are literally lining up to buy what Eos is building.
But let's flip the script. Time for the bear case: debt and margins. Because look, growth is incredibly expensive, and for Eos, scaling up casts a massive shadow. The crucial point here is this staggering figure. Eos is sitting on nearly $1.2 billion in total debt as of Q1 2026. This isn't just a minor speed bump. This is a towering wall of leverage that they have to service while desperately trying to achieve profitability. When we break down that massive debt stack, you see a really heavy reliance on convertible notes, over $700 million of the total right there. It also includes a Department of Energy loan facility, and get this, they recently needed a consent agreement just to defer their minimum revenue and EBITDA covenants out to 2027. For the bears, that deferral is a glaring red flag signaling that their initial operational timelines totally missed the mark. And here is the real kicker. Despite that massive 445% revenue jump we just talked about, the bears are quick to point out that Eos still posted a $44.4 million gross loss in Q1. Now, sure, that's a 157 percentage point margin improvement year over year, but they are still operating deeply in the red. They're still spending way more money to manufacture these systems than they actually earn by selling them. Looking back at 2025, management actually admitted to major throughput constraints during their transition to automated manufacturing. The CEO flat-out stated in the annual report that the reduced output late in the year was an execution failure. For the bears, this is just a stark reminder of operational vulnerability in an industry where, frankly, flawless execution is mandatory. Okay, moving on to our next round, the bull case. The tech is scaling. The bulls will argue those 2025 hiccups are completely in the rearview mirror now. Think about it. These deployed Z3 battery modules aren't just prototypes anymore. They are functioning grid assets. They recently surpassed an impressive 6 gigawatt-hours of discharged energy across roughly 3.9 million cycles. The Z3 leverages a proven chemistry with a redesigned architecture that cuts costs and makes it way easier to manufacture. A huge part of this bull argument rests on DawnOS, their new proprietary software. They shifted from managing batteries at a clunky string level down to individual module level management. Why does that matter? It stops one bad module from dragging down the entire system. The result is dramatically stabilized round-trip efficiency in the low to mid-70s, and a system that dynamically balances itself. And their physical expansion totally backs up this operational progress. The new Thornhill facility in Warrendale brings full manufacturing redundancy online.
Even better, it slashes material travel distance in the factory from 2.1 miles down to just 1,500 feet. That is a massive, game-changing leap in streamlining movement and boosting labor efficiency.
As the CEO pointed out, the factory metrics are moving exactly where they need to go. Manufacturing overhead per cube is down 43% year over year, and direct and indirect labor man-hours per cube are down 54%. The bulls look at this and see a company whose investments in factory automation are absolutely paying off.
All right, stepping back into the bear case, execution and risk.
Because let's be real, massive scale inherently brings massive execution risks. The 10Q report is literally flooded with them. They have to maintain that DOE loan compliance, navigate complex supply chains, and crucially, they noted how incredibly difficult it is for their own customers to secure financing for these massive infrastructure projects. It is a huge industry-wide bottleneck right now.
And to fix those bottlenecks, Eos needs capital. A lot of it. Shareholders recently approved bumping authorized common stock from 600 million up to 800 million shares. This was done to help fund a new joint venture called Frontier Power USA. But for the bears, authorizing 200 million new shares raises serious, immediate alarms about massive stock dilution down the line.
That brings us to the ultimate battleground, Frontier Power USA. This joint venture is designed to completely solve the industry's bankability problem by bundling the tech, capital, and insurance into one neat platform. They even signed a 2 gigawatt-hour capacity agreement. It could absolutely be the catalyst Eos needs. But it comes at the steep cost of potential shareholder dilution and immense pressure on management to execute this perfectly.
Okay, let's bring it all together for the final verdict.
When you weigh these completely polarized realities, it's wild. You've got a company confidently guiding towards up to $400 million in revenue this year, proving they really can build and ship at scale. Yet, this incredible traction is juxtaposed right alongside a $1.2 billion debt stack and a business model that's still burning cash on every unit sold while they wait for volume to overtake costs.
So, I'm going to leave you with this to ponder. In the high-stakes race to build the future of the power grid, did the bull or the bear win the debate today? Is the momentum of Frontier Power USA and a 445% revenue surge enough to achieve liftoff? Or is the gravity of $1 billion in debt simply too strong? Thanks for joining me on this explainer, and definitely keep your eyes on next quarter's margins to see which side of this debate ultimately proves right.